Well, this week, interest rates went up again. The Federal Reserve made the hike yesterday, our 7th hike of the year. Our local financial advisor, Bruce Allen of Bruce G. Allen Investments, is here with us to talk about this. Good morning.
Good morning.
Thanks for coming in. So why did this happen again?
Well, the Federal Reserve has continued to see rising prices or inflation, and so they wanted to make sure that they raised interest rates again another 50 basis points or half a percentage point to make sure that they try to cool off the inflationary pressures in the economy.
The 7th time this year. It's the highest rate in 14 years. Is there any indication that they didn't raise it as much as the previous ones, if that's an indicator of anything?
Yeah, I think that there's some evidence to suggest that the inflation rate may be starting to cool off a little bit. So we saw that back in June, prices were rising at over 9% a year, and now prices are rising up a little more than 7%. And while that's still very high, the interest rates that the Federal Reserve have already implemented are starting to take some effect, and inflation is starting to cool off, at least in a lot of areas. Not all of the areas that they want, but it's starting to cool off. And it looks like the next two interest rate hikes will be 25 basis points or 1/4% in February and March. So we'll finish out where these rates are going to be at around 5%.
That was going to be my next question. How many more hikes do you foresee?
My best guess, and it's my opinion and my best guess based on the evidence we see, is we're going to see two more, one in February, one in March. And there's a giant caveat here. We just talked about this a second ago. The Federal Reserve has raised these interest rates faster than any other time in the modern era. In fact, in 2004 to 2007, it took them 26 months, over 2 years, to raise rates 4.5%.
Wow. We
started at 1/4% this year, coming into this year, and starting in March, over the last 9 months, we've gone up to 4.5%. So the impact of these rates is just starting to be felt. And it's likely that we're going to see an economic slowdown if we have not already seen one. So the impact is on the economy is still going to start being felt as we go forward in 2023.
Okay, so what is the outlook for inflation and how are the markets reacting to everything?
It's likely that inflation will continue to decline towards that 2%, but the concern that the Federal Reserve has is it won't get down to 2% in the next year, and that may mean that they leave interest rates higher, and that may cool the economy off too much in terms of where we go into a recession. The biggest thing that we saw yesterday was that the Federal Reserve is very comfortable seeing the labor market suffer some pain. What does that mean? We're at 3.5% unemployment right now, meaning 3.5% of the 160 million of us that work are out of work. That's likely to go up to 4.6% is their best guesstimate right now, according to the Federal Reserve. That means roughly 1.5 million Americans will probably lose their job next year if they're right. So Jerome Powell and his colleagues at the Fed think that that economic pain is worth the price of getting rid of this inflation. So that's what we're likely to see, is how do we balance out those pluses and minuses next year with some challenging choices that the Federal Reserve has made.
Yeah, it's walking the fine line. So essentially, if you're wanting to buy anything big, it's going to cost you more, but if you can save, it's going to be better for you.
Yeah, I think that there's a couple of things. One is it looks like the housing market may have turned over a little bit, or at least is cooling off, and the Federal Reserve is hoping that that will cool prices down. So we may see an improvement in prices there, but in terms of what we see going forward in terms of the price action on individual commodities, I mean, it's anybody's guess at this point.
Oh man, well, always appreciate you coming in.
Surely.
Thank you so much, Bruce.
You bet.